Welcome to Breaking News to Trading Moves. Today, we're looking at some reports doing the rounds about BILL Holdings, that's ticker BILL. It's really sparked a lot of chatter, and maybe more importantly, it's acting as a sort of a valuation marker for financial technology companies.
That's right. BILL, Bill Holdings, saw its stock jump. The trigger was reports suggesting it's exploring strategic options. Could even be an outright sale.
And there's some activist pressure involved?
Yes, apparently Starboard Value is pushing things along. So the company's brought in advisors, talking to bigger players, private equity too, seeing who might be interested.
Okay, nothing concrete yet.
No, definitely not. It's crucial to remember this is all exploratory right now. A deal is absolutely not guaranteed at this stage.
Got it. So for you listening, what we're really seeing here is a public test, you could say. How do these big potential buyers value a quality mid-cap software and payments company right now, especially, with interest rates where they are?
Exactly. Money's tighter. Valuations are under scrutiny.
So our task today is to go beyond that headline. We want to look at the direct consequences, the implications of this potential move. We'll try to pinpoint which companies, which parts of the market might benefit the winners, if you will, and which ones might face some new challenges, the losers.
Right, because this isn't just about BILL. It's about what price tag gets put on these B2B fintech assets generally.
What does a potential deal tell us?
Well, if BILL does get acquired, and especially if it's at a premium price, that immediately signals where capital wants to flow within fintech, particularly in that really critical business-to-business space.
So it's about how that valuation transfers or maybe gets compared across the board.
Precisely. That's what helps us identify these winners and losers.
Yeah.
We need to look closely at the multiples, understand why some peers might get a lift from this news, and why maybe some older incumbent players might find it harder to compete or acquire.
Okay, let's start with those who potentially gain from this situation. First category seems obvious. SMB, fintech, and payment software. That means BILL Holdings itself, BILL, and maybe a key peer like Shift4 Payments, ticker FOUR.
Makes sense. The basic idea here is that if someone pays a premium for BILL, it really underlines the strategic value. It says these scalable platforms focused on small and medium businesses handling workflows and payments are highly desirable assets.
So for BILL shareholders, the win is pretty direct.
Absolutely. It's validation. BILL has built this specialized platform, it essentially manages the admin rails for accounts payable, accounts receivable for SMBs, paying bills, getting paid, they automate that.
Stuff businesses have to do.
Exactly. So if BILL gets bought at a price above where it was trading, that difference, the takeover premium, that's the direct win for current shareholders. It kind of proves the thesis that these specific software tools would eventually be valuable targets.
And we saw the stock react right away when the news broke. Just the possibility of a deal was enough. But if a deal actually happens, what kind of details, what kind of price would really send a strong message?
You'd be looking closely at the valuation multiple, probably relative to forward revenue, or maybe more specifically, recurring revenue. Given BILL's growth, and they're moving towards better profitability, anything over, let's say, 10 times next year's revenue, that would be seen as pretty strong in this market for a company its size.
And what would that high premium signal?
It would signal that buyers are willing to pay up, not just for the transactions BILL processes now, but for the stickiness, the long-term subscription revenue that comes from the software itself. That's the key difference, right? Valuing a payment processor versus valuing a workflow automation company. The second one gets a premium because customers are locked into the software, which makes the payment part super reliable.
Okay, that makes sense. Now, what about the effect on peers? You mentioned Shift4 Payments, FOUR. Why does talk about a B2B accounts payable company like BILL create optimism for FOUR? They seem more focused on point of sale, restaurants, e-commerce.
Yeah, they have different front ends, but the common thread is controlling the payment flow, owning the pipe, as they say. BILL focuses on that back office B2B pipe invoices, paying vendors. FOUR is more on the front-end consumer payment type.
But the underlying value is similar.
The strategic value, yes. The M&A buzz around BILL validates the idea that controlling specialized, scalable payment infrastructure built on good software is valuable. Full stop. The market sees this and thinks, okay, if BILL's specific type of payment control gets a high valuation, maybe this whole category of software-led payment platforms is undervalued.
So FOUR, with its own scale and integrations, gets looked at again, a potential re-rating.
Exactly. Investors start thinking, okay, BILL might get X multiple, let's apply similar logic to FOUR's numbers, their growth. It
Well,
lifts expectations.
so the takeaway for FOUR is that the market's recognizing the value in owning those SMB payment rails. Doesn't matter if it's handling credit cards at a cafe or supplier invoices, it's a premium model.
Precisely. It underscores this big trend. Payments aren't just a utility anymore. They're embedded. They're a high-margin feature of essential software. FOUR benefits because their strategy aligns with that integrating software and payments in their specific markets.
Okay, moving beyond the direct payment peers, let's talk about our second category of potential winners, back office SaaS platforms. You're thinking companies like Intuit, ticker INTU, and Paycom software, PAYC.
That's right. They're also in this workflow plus payments world. So if buyers are willing to pay a premium for BILL, it kind of validates the value proposition of these integrated SMB finance tools more broadly.
How does this play out for Intuit, INTU? They're already huge with QuickBooks.
Well, that's the point. The implications could be really significant here. BILL handles a specific vital piece, payables and receivables. But INTU, through QuickBooks and everything connected to it, they handle practically the whole financial picture for many small businesses.
Yeah.
General ledger, taxes, often payroll too.
So Intuit's ecosystem value is key here. They've built this incredible moat already. A high price for BILL just reinforces INTU's position.
Think about it relatively. If BILL, which handles payments around the core accounting system, is worth, say, $15 billion in a premium deal, what does that suggest about the value of INTU? INTU sits right at the center. It controls the core billing, payroll, tax workflows. The BILL situation suggests the market will pay a lot for software that drives transactions.
And Intuit is deeply embedded.
Deeply. So its moat looks even stronger. Its whole integrated offering gets validated as the kind of gold standard. It basically puts a higher floor under INTU's already high valuation. It justifies big acquisitions they've made like Credit Karma or MailChimp by showing just how valuable it is to control those financial friction points for SMBs.
It makes INTU look even more untouchable strategically.
In a way, yes. The logic follows that INTU itself would be a massive prize, though maybe too big to acquire easily. But the perception of its value is strengthened. Its control over core SMB finance is almost total for millions of businesses. This reinforces its defensibility, its ability to charge for integrated services, what some analysts call that ecosystem tax. Switching costs are just huge once you're running on QuickBooks.
Okay, let's shift to Paycom software, PAYC. Similar validation idea, but their focus is different payroll. That adds complexity, right? Regulation.
Yes, and that regulatory complexity is actually a big part of its value proposition. PAYC's focus on payroll workflow makes its model structurally similar to what's being rewarded with BILL, a profitable, sticky workflow.
Payroll is definitely sticky.
Extremely. Mistakes are costly for businesses, compliance is mandatory, and it involves very frequent, very reliable payment flows. So if the market confirms a premium for automating BILL's payables, it also implicitly confirms the premium for automating complex, regulated payroll.
PAYC handles the compliance and executes the payments.
Right. That combination is a cash-generating machine. It reinforces this idea that integrated B2B finance is highly valued. PAYC essentially sells efficiency and regulatory peace of mind through its software, and the result is reliable, high-margin payment processing. So if BILL's B2B payables revenue is seen as highly valuable, PAYC's revenue from essential payroll services looks even more attractive to investors. It helps justify the high multiples they often trade at.
All right, our third group of potential winners feels a bit different. Private equity firms and the deal makers. Thinking Blackstone, BX, and Goldman Sachs, GS. The idea here is that a successful BILL deal just adds momentum to software and payments M&A overall, benefiting advisors and buyers.
Yeah, let's break that down. First, the advisors, like a Goldman Sachs GS. Doesn't really matter who buys BILL or even if the deal closes. Just exploring the option feeds the advisory pipeline. A multi-billion-dollar deal for a public tech company. That's complex work.
Lots of billable hours.
Exactly. Due diligence, financing, fairness opinions, structuring the deal. Banks like GS make substantial fees advising either the seller, BILL in this case, or the potential buyer. And a high valuation for BILL is also a signal. It confirms that big deals can get done, even in this environment. That's great news for investment banking revenue streams overall.
It builds confidence in the M&A market.
It absolutely does. Every successful large deal, especially involving a sought-after tech asset at a good price, boosts confidence. And that confidence means more potential mandates for the big banks. They can then go to other mid-cap software companies and say, look what BILL might get. Maybe you could too.
Okay, now the private equity angle. Firms like Blackstone, BX. How does a potential BILL take private fit their strategy?
It expands their target list, essentially. Private equity firms have been hunting for a while now. They're looking for these undervalued, cash-generating software as a service, SaaS assets, ones with defensible revenue streams that they can optimize away from the glare of the public markets.
And BILL fits that description.
Perfectly, you could argue. Strong recurring revenue, high customer retention, reliable transaction volumes tied to essential business functions. So if BILL does go private, especially at a premium, it confirms for BX that sophisticated buyers are willing to pay up for operational control of these B2B finance rails.
Why? What's the attraction for PE?
Predictable returns that can be leveraged. It validates their whole hunting strategy. Find software platforms where you can improve margins through efficiency. Cut public company costs. Maybe focus investment purely on the product, not on hitting quarterly numbers. For BX, it suggests the risk in putting big money into B2B software is maybe lower than in other tech areas because customer retention is usually higher, cash flows are more visible. It's a positive sign for anyone looking to do deals in enterprise software.
So a BILL deal isn't just good for its shareholders. It could be a green light for more big capital to flow into this specific type of integrated B2B software space.
That's a good way to put it. It signals opportunity for those big financial players.
Okay, we have to look at the other side too. Who faces maybe increased pressure or risk because of this BILL valuation news? Let's start with what you might call legacy payment processors. Companies like Fidelity National Information Services, FIS, and Global Payments, GPN.
Right. The core challenge for them is pretty straightforward. If BILL fetches a really high price, it makes it more expensive and more difficult for these incumbents to buy the modern fintech assets they really need to stay competitive.
Why do they need to buy them? Can't they build?
It's tough. We're talking about technological debt and just the cost of capital. Sure. FIS and GPN have historically grown and modernized by making large acquisitions. But when a key asset like BILL potentially commands a premium valuation, it resets the price expectations for the whole sector. Suddenly, paying, say, 15 times revenue instead of maybe 8 times really squeezes the potential return on that investment.
And they're competing against different types of buyers, too.
Exactly. They might be bidding against a big strategic buyer who sees huge cost savings by combining operations, or against a private equity firm focused purely on financial engineering and optimization.
Yeah.
That inflated price tag makes it much harder for the legacy guys to make the numbers work for their shareholders.
What's the risk if they don't buy, if they lose out on targets like BILL?
That could be worse in the long run. They risk getting stuck with older technology, maybe mainframe-based systems, at the very moment their customers' SMBs are moving decisively towards flexible, integrated software-first solutions like BILL. It just accelerates their own technological obsolescence.
You mentioned building it internally is hard. Why is that for these big established companies?
It's a mix of things. Architecturally, building a modern, cloud-native, API-first system is fundamentally different from maintaining decades-old legacy infrastructure. Organizationally, resources are often tied up just keeping the old systems running. Development speed is slower. And culturally, they often lack the specific B2B software engineering talent and mindset that a company like BILL was built on.
So acquisition is often the only realistic path for speed.
For rapid modernization, yes. So when that path gets much more expensive because target valuations go up, their ability to compete effectively starts to erode. The BILL news doesn't just mean more competition. It potentially means a literal price increase on their own future competitiveness.
They're in a tech race, and the cost of entry just went up.
That sums it up well. And think about who might buy BILL. If it's a big tech firm, maybe one not traditionally in payments, they instantly get a major foothold in this high-growth SMB B2B space. That puts huge pressure on incumbents still using older systems.
Okay, second category of potential losers. High-growth fintechs without strong profits. You mentioned Affirm, ticker AFRM, and Marqeta, MQ. What's the issue for them?
It's about where the market's attention and, crucially, M&A money seems to be flowing. The focus right now, highlighted by the BILL situation, is squarely on profitable, essential B2B models. That might divert interest away from fintechs that are growing fast but aren't consistently profitable, especially those in consumer or infrastructure areas.
So it's a signal from the market. Profitability and reliable cash flow are highly valued right now.
A very loud signal. BILL provides a B2B service tied to something businesses absolutely have to do, managing payments. It's not discretionary. And while BILL grew quickly, the potential premium valuation now seems linked to the fact that its model is maturing, generating cash, and keeping customers.
How does that contrast with, say, a firm, AFRM? Their buy now, pay later model seems different.
Very different risk profile. AFRM has direct exposure to consumer credit risk. Their success is tied to retail spending cycles, consumer behavior, and managing defaults. BILL's revenue feels more recurring, more stable, linked to business admin. Its main risks are operational, not credit-based.
So if buyers are prioritizing the stability of BILL's model,
Then companies like AFRM or MQ might find themselves lower down the M&A priority list for a while. It suggests the market wants stability, maybe even over just pure growth right now, paying a premium for certainty.
what about Marqeta, MQ? They
Right.
provide critical card issuing infrastructure. Isn't that essential?
It is essential, but it's infrastructure. It's often invisible to the end user, and there's always a risk that infrastructure becomes somewhat commoditized over time. MQ provides a foundational layer. Growing revenue there often means heavy, ongoing investment to stay ahead.
Whereas BILL captures value differently.
Yes, buyers right now seem to prefer platforms like BILL that capture value at the application layer, where the business user directly interacts with software that solves a critical problem. So, if investors draw the conclusion that only profitable established B2B platforms are likely to get premium acquisition offers, then infrastructure players or consumer fintechs with higher risk profiles might trade at lower multiples. Makes it harder for them to attract those top dollar bids.
It reinforces a preference for proven B2B cash flow over maybe more speculative, capital-hungry growth.
Especially with the current cost of capital. Buyers want to see a clear, relatively quick path to positive returns. BILL seems to offer that clarity. AFRM's path is more dependent on variables like consumer health and interest rates.
Okay, final category on the potential downside. SMB platforms that don't get a bid, at least for now. Thinking about major players here, like Block, ticker SQ, and Shopify, SHOP. What's the risk for them?
Well, there's an immediate effect and a longer-term concern. Immediately, all the takeover speculation, the valuation uplift buzz, it's focused on BILLOSQ and SHOP, are left relying on their own organic growth stories for now.
That seems like an opportunity cost, maybe, but what's the deeper, longer-term risk?
The bigger concern is competitive. What happens if BILL does get taken private by someone with really deep pockets? Imagine a large strategic buyer or a major PE firm acquires BILL and then pours capital into it, integrates it more deeply. BILL could suddenly become a much stronger, much more aggressive competitor to both SQ and SHOP.
How so? What changes if BILL goes private?
You have to contrast public versus private operations.
Yeah.
SQ and SHOP are public companies. They live quarter to quarter. They face constant market scrutiny, pressure to meet earnings expectations, justify spending to shareholders. It can force a shorter-term focus.
Okay. And a private BILL wouldn't have those constraints.
Not in the same way. A private owner could afford to make strategic long-term moves that might hurt profitability in the short run, something public companies often can't tolerate. For example, a private BILL could decide to drastically cut prices on its software or transaction fees for a year or two just to grab market share aggressively. They wouldn't have to answer to public markets about the immediate margin impact.
Or invest heavily in R&D or integrations without worrying about the quarterly earnings call.
Exactly. They could pour money into connecting BILL's payables tools directly into, say, inventory systems or logistics platforms, building a more comprehensive offering faster than public competitors might be able to justify. This freedom from quarterly reporting cycles gives them immense flexibility.
And this matters because BILL targets the same customers, small and medium businesses.
Yes, there's significant overlap. SQ through its Square ecosystem and SHOP through its merchant services both serve that SMB market intensely. If BILL gets supercharged with capital and operational freedom, the fight for that SMB wallet share gets tougher. It could potentially slow growth for SQ and SHOP or force them to spend more, compressing their own margins.
So what looks like just news about BILL could actually mean the emergence of a newly formidable private competitor for Block and Shopify, one with potentially more resources and strategic freedom.
That's the potential long-term risk, yes. A competitor operating under very different rules. Hashtag outcheck outro.
So looking back at everything we've discussed around these Bill Holdings reports, it really paints a clear picture of what the market values right now. This whole situation feels like strong confirmation. Sophisticated buyers are putting a high value on these integrated B2B software and payment platforms, especially those that are profitable and control essential business workflows.
Absolutely. The key asset seems to be that control over the workflow, payroll, accounting, payables, receivables. If you're a fast-growing fintech, just having huge transaction volume isn't enough anymore, it seems. You need to show you can turn that volume into reliable, sticky, profitable cash flow. The BILL model represents that, and that's what seems to be commanding the premium valuation talk.
Okay, so if this potential BILL deal sets a new high benchmark for profitable B2B finance software, particularly for SMBs, what are the wider implications beyond the public companies we've named? Thinking about all the private companies in this space, how might their investors, their management teams react? Could this speed up M&A in related areas?
That really is the big question to think about, isn't it? Does this potential high price tag for BILL make similar private companies push harder and faster towards profitability so they can command a similar exit multiple? Or maybe does it just encourage them to hold out, thinking valuations across the board are heading higher? We'll have to watch the next few months of deals in the private B2B software world. That will tell us if this BILL situation is just one specific case, or if it's really kicking off a new cycle of M&A activity driven by these valuations.
Food for thought, definitely. And just before we wrap up, the mandatory disclaimer. This analysis reflects purely the opinion of the author. This is not financial advice. It's not a recommendation to buy or sell any security we've mentioned. And we have mentioned quite a few. Bill Holdings, BILL, Shift4 Payments, FOUR, Intuit, INTU, Paycom Software, PAYC, Blackstone, BX, Goldman Sachs, GS, Fidelity National Information Services, FIS, Global Payments, GPN, Affirm, AFRM, Marqeta, MQ, Block SQ, and Shopify, SHOP. Thanks for listening.